Well, hello, Business Dynamics students. My apologies for getting this to you a little later than I planned on. So let's get started. So we're moving on to chapter 17 today. So this will be the one where we cover accounting. And I think my plan is to cover all the slides today. I think we can get through it in 50 minutes or so. So if I could get started here. So let me share my screen. So these slides are available up on Blackboard, chapter 17. Okay, and here we go. Okay, so the first one we'll take a look at are the different areas of accounting. The one most people think of when they hear the word accounting is this first one we've got listed here, financial accounting. And this is the course you'll be taking next semester, a course in financial accounting. So you can see the key here is this is a way of management providing information to stakeholders, interested users outside the firm. So a key word there is external. Okay. So example, investors, creditors, suppliers, customers, employees, the local community, anybody that wants to know how well the company is doing, this is where they would turn to, the financial accounting realm. Next one is managerial accounting. And this is also a way for management to provide information. The focus here is to provide that accounting information to people inside the firm, to managers, to help them make better decisions. And finally, one other broad area is tax accounting. As the name implies, this is a field of accounting that helps companies figure out how much taxes they owe, how to minimize how much taxes they're paying, and how to build taxes into the overall strategy of the firm. So most of our discussion today, if not all of it, will be focused on financial accounting. Right? So here we can see the inputs into the accounting system. These are often what we call source documents. And we take all these source documents, we process them somehow. 60 years ago, that would have been done by hand. Today, virtually all this is done by computers, and scanning devices, and the like. Then once we've got all that information in the system, the goal is to produce the outputs. And as you learned about in the chapter, you're preparing a set of financial statements. And the three main ones we'll look at: the balance sheet, the income statement, and the statement of cash flows. All right. So as part of getting us ready to prepare those financial statements, we go through what is known as the accounting cycle. So the accounting cycle, as the name implies, is this repetitious series of events that we do over and over each accounting period. And what we mean by an accounting period is a time period for which we're going to prepare financial statements. So that could be monthly, could be quarterly, could be annually. Okay. So the accounting cycle, the steps we go through, let's say every year, in order to help us prepare the set of financial statements. Okay. So here we can see the steps. Okay. So as we saw before, the first part is to take a look at those source documents, find the key information. For example, how many units did we sell? What price did we sell them at? And then what was our payroll? When did we pay our payroll? How much did we spend on advertising, right? So we can look through all of our documents to get the relevant information. Then we enter that information into the system using what are known as journals. So again, if we were to go back 60 years ago in a paperless accounting system, companies would have two basic books they would use for their accounting purposes. One is a journal. The purpose of the journal is to record transactions as they occur in chronological order. So again, somebody goes into an Apple store, buys an iPhone for $1,000, that's a transaction. And that needs to be recorded. That gets recorded in the accounting system. Now, we don't get into it in this class, but if you've ever heard the phrase debits and credits, this is where they come into play. So that transaction, assuming it was a sale for cash, we'd say let's debit cash and credit sales. Okay, so cash is an account that companies keep track of, and sales would be another account that we keep track of, right? So that's the first step after we've analyzed the source documents, is to record transactions in chronological order. So the journal is just that listing of all these events as they take place. Okay. Then what we're going to do is copy, or the accounting word we use is post, those journal entries, the information from them, into our other accounting book known as the ledger. So think of the ledger as another book, and each page in that book is a different account. So maybe page 1 is the cash account. And that cash account, that's where we're going to be copying from the journal every transaction that affected the cash account. So when we just did, we say on October 29th, cash just went up $1,000, and we would increase cash in our ledger to show that. If later on we pay our employees $800 cash for salaries, we'd record that in our journal and then post it to the ledger showing a reduction in cash of 800. So then what we have at the end of the period, we can go to that ledger and figure out what is the ending balance for each account. So you'd start with the beginning balance, add all the transactions that increased that account, subtract all the transactions that decreased it, and that would give you your ending balance. So there's the first 3 steps. Once we've got all that information, we've got all these accounts: cash, inventory, accounts receivable, land, sales revenue, retained earnings, hundreds of potential accounts companies might have. What we're going to do next is list all those accounts, typically in order by assets, liability, and equity accounts, and write down in one of 2 columns what their balance is. So we mentioned those words debits and credits before. So cash hopefully will have a debit balance. If the balance is 200, we would write in one column, we'd write cash, and beside it, in one of the 2 columns, we'd write $200. Something like accounts payable might have a credit balance. If that balance is 100, we'd go over to the credit column and write $100 in that column. Okay. So then after we've done that, taking all those balances from our ledger and just listing every single account and what its balance is, debit or credit, we then add up each column, and fingers crossed, those 2 columns need to be equal. If they're not, then something's wrong. Okay, we don't have time to get into what could possibly be wrong, but hopefully everything balances out. All right. Once we've got that trial balance done, then we can prepare the financial statements. And the 3 we're going to look at here: the balance sheet, the income statement, and the statement of cash flows. Then once we're done and we're sharing this with all those stakeholders can take those financial statements and start analyzing. So we'll talk about analyzing financial statements at the end of today's lecture. All right, so here's the financial statements. So first off, the financial statements are highly summarized. So for example, and we'll see in a moment here, on the income statement, the very top of the income statement is sales revenue. And for Apple, that might be close to $400 billion. That's a summary of I'm sorry about that. Get back to my slides here. Okay. So we're talking about how all the numbers on the financial statements are highly summarized. So for sales, we'd see one number, $400 billion. That would be Apple's sales for the entire year. But realize that consists of millions of transactions. Somebody going into a store to buy an iPhone, someone else buying a MacBook, somebody using Apple services to get repairs. So all those sales transactions get added up, and on the financial statements, we see the final result. Okay, so it's highly summarized. So start taking a look at these: the balance sheet, the income statement, statement of cash flows. The balance sheet, what we have over here is Apple's financial statements. And the balance sheet is split into three main sections. We've got assets. So here we see assets. Then we've got liabilities, and we have shareholders' equity. So those are the three main sections: assets, liabilities, and equity. Right? And again, the goal is to make sure, and it has to work out, or else you've made a mistake, that our total assets, this number, equals the total of all of our liabilities plus all of our equity, or this number right here. So that's known as the accounting equation. Assets equals liabilities plus equity. That's the accounting equation. And that's, to me, both the beauty and the pain of accounting. The beauty is that everything needs to balance. But the frustrating part is that many times when you first do this, it may not balance. And you know you've done something wrong, then you have to go back in and find out, where did I make my mistake? Okay. All right, so let's go into each section. So first off, assets. So assets represent items of value owned by the business that provide a future benefit. All right, so that future benefit is key. If it's not providing any future benefit, then we really can't include it on our list of assets. Okay? A couple of things to note here. We split assets between current and show a subtotal for that, and then non-current. And it's optional whether you want to show a total for non-current assets. Apple does. You don't have to, but you must show a subtotal for total current assets. Then we add all the assets together to get total assets. Another way to distinguish, it's not clear here, is that we split our assets between what we call tangible and intangible. This is particularly relevant for our non-current assets. All right, so our non-current assets, for the most part, we're talking about property, plant, and equipment when we talk about intangible assets. So tangible assets are assets that have some physical presence to them. It's like property, land, a building, equipment, they'll have a physical presence to them. There are other types of assets, non-current, that do not have any physical substance to them. Things like patents and trademarks. Just as important, it's just that we distinguish between tangible and intangible. Okay, so those are assets, items of value that provide future benefit. Now we come down to liabilities. We do the same thing with liabilities. We split these between current, and we show a subtotal, and then non-current, and show a grand total. And let me go back. I should have mentioned this. Okay, what is the distinction between current and non-current? So current assets are those that are either already in the form of cash, so that's why we see cash here, or we expect to convert to cash within a year. So something like inventory. Inventory, hopefully we sell quickly and we convert that sale to cash. All that within a year, right? Accounts receivable. Accounts receivable represents amounts owed by our customers to us. We sold to them on account. We didn't ask for cash right away. We said, you can pay us in 30 days. That creates for us an account receivable. Okay. Obviously, we hope to convert that to cash relatively quickly. Okay. So those are current assets. Non-current assets are those assets we don't expect to convert to cash within a year. Right. We're going to have them around for a longer time. In fact, many times we refer to non-current assets as long-lived assets. Okay. Terms are used interchangeably. Okay. So there's the assets. Right? Going down to liabilities, what's the difference between current and non-current? This one's a little easier. Current liabilities are those that are due within 1 year. So current liability means we have to pay that in 1 year. Non-current are ones that are due more than a year out from now. right? So a straightforward distinction, right? And liabilities, as the name implies, these represent amounts that we owe, okay? And we call those people creditors, or those organizations that we owe money to, we refer to them as creditors. We also sometimes refer to liabilities as debt. It's got liabilities, debt, referred to these people as creditors, okay? The final area is shareholders' equity. So this is the owner's share of the business. Okay? And it consists of two parts. What we call paid-in capital and retained earnings. We see other amounts here, but these are the two biggies. The paid-in capital is direct investments into the business by owners. So this typically arises when we sell shares in the business. And all that cash that's coming in at that moment in time when we sell shares, that is going to go into the paid-in capital account as part of shareholders' equity. Okay. Once those shares are sold directly by the company to investors, then those shares trade in what we call the secondary market. We'll talk more about that when we get to finance. And those secondary market transactions don't directly affect a company's paid-in capital account. So paid-in capital accounts, again, direct investments into the business by owners. Okay? Then we have retained earnings, right? Retained earnings, as the name implies, these are earnings is another word for net income. So retained net income is essentially how much income we're keeping in the business as opposed to paying some of it back to our shareholders, what we call dividends. So companies have two choices what to do with their income. They can keep it in the business and use those funds to help grow the business, or they can pay it out to shareholders in the form of a dividend. And again, the amount they keep in the business is referred to as retained earnings. Okay. Okay, so again, there's the fundamental accounting equation, assets equals liabilities plus equity. It's also important to note that balance sheet accounts are what we call permanent accounts. Permanent accounts mean that the balances at the end of one period carry over and become the beginning balance for the next period. Okay. So, for example, here's cash. That's cash as of September 25th, whatever year this was. I forget what year these financial statements are. Right? So that's Apple's year end, typically the last Saturday in September. Right? So there's Apple's cash at September 25th. And now when they start their new year, September 26th of the following year, they will start with that amount of cash. So it's not like that cash magically disappears overnight. It's the same for all these accounts on the balance sheet. These are all permanent. So what we see here, these are numbers where we end it this particular year. These are the numbers where we start the following year. And we call those permanent accounts. All right, let's go to the income statement. Okay. So the income statement is going to be broken up into major categories. We think of sales, also known as revenue. So sales and or revenue, that represents, you can see here, the wealth that the firm generates from selling products or providing a service. So again, if you go into an Apple store and they sell you a phone for $1,000, that's $1,000 of revenue, of sales for Apple. Okay. This is also known as the top line. I think we talked about that very beginning of this course, right? So revenue is the top line because it's the top of the income statement. Okay. Then we start listing the expenses. Okay. Many times we split these out. Okay. Next one that's often showed is what we call cost of sales. So, for example, when Apple sold that phone for $1,000, maybe that phone cost them $280 to build, to assemble. Right? That would be the cost of the sale. Right? Then we take the difference between the revenue and cost of sales. That gives us what we call gross margin. So there's the first measure of profitability, something called gross margin. difference between what you're selling a product for and what the cost of that product is. And most times we refer to that number as a percentage by taking the gross margin and dividing it by revenue. And it gives us a percentage, and that's how investors refer to gross margin. Apple's gross margin was 42% this year, whatever it might be. Okay. Then we have the other expenses, what we call operating expenses. These are your day-to-day routine expenses: salaries, advertising, rent, utilities, depreciation. So you see here R&D. Collectively refer to many of these as SG&A, selling, general, administrative. Okay. We subtract those operating expenses from our gross margin to get our next measure of profitability, referred to as operating income. Operating income is typically the income number that is the best gauge of what we think the company will do the following year. The operating income is fairly, steady growth, hopefully, from year to year. But after this, after the operating income line down here, there could be other, now here there isn't, but there could be some unusual transactions, like if Apple sold off its Apple Store division, right? And from that sale, they recognize, let's say, a huge gain from that sale. That would be down here in this section, because we don't want to include that up here, because if investors looking at this, they can't assume that they'll have that huge gain the following year. And that was a one-time event, selling off the Apple Store. Okay. So that's where, again, we see gains and losses. So these are ones that aren't part of what we might call normal operations. Okay. So selling equipment, selling land. And on those, when we sell, we might have a gain or loss. Selling a business segment, like the Apple Store. Okay. So the income statement, really 4 parts: revenues, expenses, gains, losses. Then the bottom line is the net income. Obviously, that's a widely watched number. In fact, right now we're in the midst of earnings season, and we're hearing lots of companies report what their earnings are. And in fact, we'll often hear it referred to on what we call a per share basis. Okay? So the per share, the earnings per share, we take that income and divide by the number of shares that are outstanding. That's the shares owned by the public. So that's a much easier number to remember. So if you own 100 shares of Apple, and you see that their income was $94 billion for the year, you might be excited about that. But what you'd really like to know is, like, what part of that is really mine as a shareholder, right? Because you're an owner of the business as a shareholder. So one way to do that is put it on a per share basis. So if the per share number here is 5, you can see that 67, and you own 100 shares, you could conceptually say that $567 of that total earnings are yours. Whether or not you get any of that, that's a dividend decision. Okay, that's a separate decision. So net income, also referred to as profit, also known as earnings, also known as the bottom line, right? Because it's the very end of the income statement. Okay? These accounts are all temporary. So this is awesome, right? Apple's total sales for the year, $365 billion, right? Congratulations, great job. But guess what? That was just for this year. When we start the next year, all these numbers have to start back at 0. So for next year, we start off September 26th of the new year at sales revenue of 0. So obviously they're different than balance sheet accounts that are permanent. So income statement accounts are temporary. These are permanent. The last statement is a statement of cash flows. Okay. So the purpose of this is really to explain what causes cash to go from where we started the year with how much cash to how much cash we have at the end of the year. So we can get the overall answer pretty quickly. For what we should get for the overall change in cash, we just take the beginning amount of cash for the year, subtract it from the ending cash, and that gives our overall change. But what we're going to do is split that change into 3 major sections. Right? So the first one is cash flow from operating activities. So this is the first part. And that's what we see here. So cash from operating activity, this is the cash generated from what you do as a business, from your bread and butter activities. So selling goods, paying your employees, paying for advertising, paying for rent. This is what's listed in your cash flow from operating activities. It's critical that at some point, and the sooner the better, that this number, the net amount of cash generated by operating activities, becomes a positive number. Right? Because ultimately, this is going to be your main source of cash from what you do on a day-to-day basis. As we'll see with the other two sections, there are other ways to get cash, but we really can't count on them all the time. So we need to have this steady source of cash flow. That's our operating activities. So it may take a while to get there to become what we call cash flow positive. But when you do, it's a great moment, sort of like reaching your break-even point on your sales. And we want to get this positive, okay? So that's what we're talking about here. Positive cash flow from operations. I'll also point out of all these numbers that we're looking at, all the numbers on the balance sheet, all the numbers on the income statement, all the numbers on the statement of cash flows, from my perspective, I'm a huge fan of this number. I'd say this is the most important number on all the financial statements. Okay. Now that's a bias. Other people might say they think net income is the most important number. So it tends to fall in those two camps. Do you think income's more important, or do you think cash flow is more important? Personally, I think cash flow is, because you can't survive without it. And in particular, the cash from operations. That's got to be your key source of cash. Okay. The next part, investing activities, is the second part of the statement of cash flows. This focuses on transactions dealing with our non-current assets, right? Buying and selling them for cash. So, for example, when we buy equipment, that's a cash outflow for investing activities. If we sell that equipment for $1 million cash, that's a cash inflow for investing activities. Notice that's a different type of cash flow from cash generated from making a sale, right? Apple's in the business of making sales to customers, right? So that's the cash they got to count on day to day. On occasion, they might generate cash by selling off some equipment or some land, but it's not something they really count on as a sustainable source of cash flow. Okay. Now this number, notice at the end here, this number is negative. Okay. And that's fairly common for the investing section. It means that you paid more for these non-current assets than the cash received from selling them. And say here again, that's okay to be negative. And it's usually a sign of confidence in the future of the business. Now, you probably wouldn't see companies going out and making purchases of assets going to last 20 years if they don't think they're going to be around in 2 years. So buying long-lived assets generally a sign that they're confident in the future of the business. So and that one's okay, and it's fairly typical for that to be negative. Okay. The last section is cash from financing activities. So this really focuses on what we call institutional debt. So that's borrowing from a bank or bondholders, right? So debt and anything dealing with our shareholders' equity. So if we sell stock and generate X amount of cash, that's a cash inflow for financing. If we pay a dividend, that comes out of retained earnings, that's a cash outflow. You know, it's become very popular for many firms over the past several years to buy back some of their stock. That's a cash outflow related to shareholders' equity. So that would show up in the financing section. So here we see that. That's a pretty big number. Apple's been one of the biggies for that, buying back their stock. Okay. This one, whether or not it's going to be positive or negative, right here it's negative, cash used in financing activities. And this is the third area. That's going to ebb and flow with the life of the business. Most likely early on, this section will probably be the key source of cash. Startup, they're probably not generating much revenue yet. And they're going out and buying long-lived assets, right? But they need cash. So where's the cash going to come from? Most likely either borrowing or raising capital by selling stock in the business. So again, early on, this could be a major source of cash for the business. Then if it's debt, at some point that needs to be paid back. So when you pay back debt, that's a cash outflow for financing activities. Okay. So there's the three sections. So we would net those three areas together: operating, investing, and financing. We see that overall cash decreased, in this case for the year. We would add that to the beginning balance of cash, and that would give us our ending balance of cash. Okay. So we're going to go back. There's our beginning balance. Right? So that's where we start. And then we take this decrease of 3,800 and we get our ending balance of cash. So that's the statement of cash flows. All right, so let's look at some concepts of accounting. There is something that we refer to it as GAAP, generally accepted accounting principles. These are the rules and the guidelines and the procedures that accountants must follow when they're recording transactions and preparing financial statements. A major reason why we have these is to ensure the reliability of the financial statements. We don't want companies going off on their own and just recording transactions any which way they feel. And it also allows for comparison from one firm to another, knowing that they're all using the same set of rules and procedures. Okay. So there is, briefly we'll talk about some international accounting issues. So obviously, as we've talked about many times, the world is global. And so there's companies all around the world, and companies have divisions all over the world. And if we were to go back 40 years ago, every country had its own GAAP. So there was Indian GAAP, British GAAP, French GAAP, South African GAAP. Every country had their own. Then as the world became more global, more connected with these firms, people started saying, wouldn't it be nice if every country, every company in every country just simply use the same GAAP, essentially? So that way it would make it much easier. And then when you're transferring dollars over, financial statement information over from, let's say, France to the US, it's all the same accounting system that's been used and same procedures. Okay. So that started a movement known as IFRS. So there's IFRS, International Financial Reporting Standards. Okay. And the goal of that, again, was to get what we call convergence, that every country had the exact same GAAP. At this point, as we can see, 148 jurisdictions, countries, and principalities require companies in that jurisdiction to use IFRS. So it's not bad. There's probably roughly, I don't know, there's more that allow companies to use it, but it's their choice. So this is required. The big holdout, the US, has not fully adopted IFRS. Okay? So the US, considered to have the gold standard of accounting with US GAAP, still just feels that there's some significant differences between US GAAP and IFRS that rule makers just don't feel comfortable switching completely over to IFRS. So this movement started, I guess I should know this off the top of my head, but I'm saying 20 to 30 years ago, perhaps. And the hope was that, again, eventually, US GAAP and IFRS would converge, be exactly the same. But from my perspective, that hope maybe has faded a little bit because now it's just in the steady state where there's this distinction between IFRS and US GAAP. Should point out, they're much more similar than they are different. There are some important differences, but for the most part, there's a tremendous amount of overlap between the two approaches. All right. So let's move on to this. And this is where you're going to have an assignment. You're going to have an assignment where you can look at NVIDIA's 10K. Okay? And you're going to do analysis of that 10K. Okay? So the 10K is the form.
Is there something else I can help with?
The 10K is the form that if you're a publicly traded firm, You must file this on an annual basis with the SEC. So this is required filing by publicly traded firms with the SEC. Okay, and we'll take a look at one.
Here's an answer from TheBalanceMoney.com.
So since it's a form, it's a standard form for everybody, typically 15 items. Okay, and a couple of the key ones, we're going to take a look at item 8. This is where we see all the financial statements you just talked about. Plus, we're going to see the auditor's opinion. So again, it's the companies that prepare these financial statements. So all those financial statements of Apple that we looked at, they are all prepared by Apple. You can imagine if nobody's really looking at those financial statements, they might be incentivized to maybe fluff them up a little bit, make them look as good as possible. Well, that's where the outside independent auditors come in, the big four in many cases. That's their role, to come in and check these financial statements, run various tests. For example, Apple's claiming sales were $400 billion. We're going to do some confirmation of that. Let's see where those sales came from. Okay. So the hope is after the auditors are done, they'll file this report, and you're hoping for what is known as a clean opinion. Okay. And here's what that would say. So in our opinion, the financial statements present fairly in all material respects the financial position of Apple at these years and the results of operations and cash flows for each of the 3 years, the period ending 2021, in conformity with US GAAP. So that's known as a clean opinion, and that's what you're hoping for. There are other types of opinions we don't have to worry about here. Okay? There's another section of the 10K known as MD&A. This is where management discusses how well they did for the year. So you have to realize this is inside the 10K. So this is going to be checked by the auditors. So you can't be making things up. Like we expect our sales to increase by 55% next year, when there's perhaps no basis for saying things like that, right? So these are going to be, checked as well. But this is a good way of getting a sense of what management thought about this past year. How well did the company do? And maybe some suggestion about how they're going to do in the future. And then obviously, if there's 15 items, there's a lot more in this document. So it's a very rich document. It's a great way to learn more about a company. And I mentioned before that, Warren Buffett reads all day. What does he read? A lot of his time is spent reading these 10Ks and gaining insight into companies that he's investing in or thinking about investing in. Okay? So we should point out that some companies also have something known as an annual report. The annual report is this glossy document, and next time I'm back in, hopefully I remember to bring one in to show to you from Disney. That have all these nice pictures of the company's products, talk about what they do. Typically has a letter from the CEO or another high-ranking officer, and then it'll have the 10K at the end of it. Right? Some companies just simply use the 10K as their annual report. Other companies enhance that 10K with other information that's outside the 10K. And that's all part of what they call the annual report. Okay. All right, so let's take a look at Apple's 10K. So how do you find this? And this is going to be important for NVIDIA, right? So if I go out to apple.com, where I could search for Apple SEC filings, I'll do it this way. So we need to go down the bottom here where most people aren't going, right? We need to come down here and we're looking for investors. This is called their investor relations department. Right, so there's investor relations. And what we're looking for, the SEC filings. And we're looking for the annual one. So companies also have to do quarterly filings. One annual. Let me see what is going on here. Do back to SEC filings. annual. I just did this a half hour ago, getting ready for this, or 45 minutes ago. So why are these coming up? I see the 10Q. I'm looking for the 10K. Another 10Q. There we go. Why it usually pops up the first line. I'm not sure why it's buried down there. So let's take a look at Apple's 10K. Okay. So there's the form 10K. Find this with the SEC. And this is what you'll be using for your assignment. You need to look for NVIDIA's 10K, not their annual report, but more specifically their 10K. So here's these roughly 15 items. They have 16 with this summary. And here's item 8, the financial statements. And here's the various ones. So if you scroll through this, this is where I got the documents from. So there's their income statement. They're calling it a statement of operations. There's their sales, cost of sales. Here's their balance sheet. Right? Current assets, non-current assets, liabilities and equity. Then here is the statement of cash flows broken into those 3 sections. Okay. Then finally, this we have the notes to the financial statements. That's where we can provide more detail, like where these numbers come from, what they really mean, and the like. And if we go back here, we'd also see here's a report of the independent accounting firm, the Big Four firm. So the question was, who did the audit here? We could look this up. Come here and find out that looks like Ernst & Young did the audit, and they've been doing it since 2009, and it was their San Jose office did this. And if you scroll up here, we're looking for that opinion. So the results of the operations present fairly, right? The financial statements present fairly. So there's that clean opinion that we were talking about, right? So I said you're going to have a assignment dealing with NVIDIA's 10K, a series of about 10 questions. Some of them have multiple parts that you need to work on. Okay. The last thing then is to get in the financial statement analysis. Right? So we've got these financial statements, right? So we share these once they're filed with the SEC, they're publicly available. So all these stakeholders we talked about are going to look at these and try and make sense of them. Okay. So one approach to doing financial statement analysis is do what we call ratio analysis. Okay. And there's various ratios that we can look at. Okay. So we can split them into various categories like liquidity. We'll talk about each of these, go through these, leverage, profitability, and activity. Right? So liquidity. Liquidity is really the firm's ability to pay their bills as they come due. So again, if you think about that, what bills are coming due? That's your current liabilities, those items that are due within a year. And so we need cash available to us within a year. That's our definition of current assets. So a great way to put these two numbers in perspective is to compare current assets and current liabilities, divide one by the other. And that gives us our first ratio, known as current ratio. Many people have said a rule of thumb, this should be around 2. that we should have twice as much current assets, current liabilities, because that will bring some comfort to companies that we owe money to look and say, it looks like they've got enough in current assets to be able to pay the amount they owe us. Okay. If you look at some really big companies, they keep it much closer to one. Okay. Because you don't want to tie up a lot of dollars in current assets. You don't want that ratio too big. Because you think about that top number of current assets, things like cash, receivables, inventory, and think about the return you're getting on those. You're getting, minimal or no return. And as an investor, as a shareholder, that's not why you bought stock. You bought stock to get, 15, 20% returns. So as an investor, you don't want to see a lot of dollars tied up in assets that aren't generating good returns. That's really what current assets are. So many big firms keep this close to one. Right? Then we have what we call leverage or debt ratios. Just comparing our debt to our equity. And the higher this number is, it could be a sign of increased risk. And the risk we're talking about, if your debt, your numerator gets too high, there's a danger you're not going to be able to pay it off. So many firms look at their debt to equity ratio and like to keep it within a certain range. And as it gets higher, it could potentially be a sign of risk. As a creditor, you'd prefer to see this really small, the debt to equity, because the smaller it is, the more likely the company's going to be able to pay how much they owe you. If this ratio gets to be really big, sign of having lots of debt, creditors might be concerned you're not going to be able to pay them off. Okay. I don't know if you caught that. I was trying to fake you out that I was fainting again. Anyway, try and liven things up here. All right. The next one, a profitability ratio. There's different ones here. We've already talked about the gross margin, right? That's your gross margin divided by revenue. We talk about profit margin. That's your bottom line divided by sales. That's telling us for every dollar of revenue, how much is left after all your expenses as profit. So that's a widely watched metric. There's the EPS that we talked about. That's quoted all the time, particularly when companies are announcing their earnings. Say their earnings were X amount, and on a per share basis was this much, and whether it exceeded or was below expectations. Okay. The one we'll look at here is ROE, return on equity. Return on equity is taken, when we generally see a return mentioned, that's income, and equity is your shareholders' equity. But notice this is slightly different than other ones many times. So, for example, gross margin, this would be, 19. This would be like 2025 gross margin divided by 2025 sales. Makes sense. Okay. Just do it that way. However, because they're both on the income statement, when you combine a number that's on your income statement, like net income, with a number that you find in your balance sheet, you typically want to average your beginning and ending balances. Okay? So that's what we're doing here. So here's from these financial statements you just looked at, the most recent year. There's Apple's net income, $94 billion. Here is their equity at the end of, I think this was last year. Here's their equity this year. We add those two numbers together to get an average. The reason for doing that, we think, well, the income is being generated over the course of the year, whereas the shareholder equity numbers are either a beginning of the year number or end of year number. So to try and get a rough estimate, maybe what it was on average throughout the year, we do this averaging process. Okay. And just as an aside, that is a phenomenal return on equity. Usually expect return on equities maybe 10, 15, 20%. 147% is again phenomenal. Okay. What was on here? My apologies here. Not sure what's frozen. Guess I'll have to do this and close that and bring it up again. So activity ratio is really a measure of oftentimes what we refer to as efficiency, something like your inventory. With inventory, what you like to do is sell your inventory relatively quickly, and you don't like it hanging around. If your inventory is hanging around too long, it could be a sign that people aren't interested in buying it, greater chance to become obsolete, whatever the case may be. So this particular ratio, known as average days inventory, takes your average inventory. So again, notice we're comparing an balance sheet number, inventory, with an income statement number. So for the balance sheet number, we need the average beginning and ending. We divide it by your average daily cost of goods sold. Okay. This will give us number of days, like 30, 15, whatever the case may be, right? With this number, you like to be right around whatever your policies are. You like to sell your inventory every 30 days. Well, hopefully it comes out to be 30. If it gets to be 60, 70, 100 days, you're going to get concerned. If it gets too small, you might be concerned that you're not going to have inventory on hand when somebody comes in to buy something. So you walk a fine line with this average days inventory ratio. Okay. Finally, some careers in accounting. Talked about the big four, that's referred to as public accounting. You do audit, tax, consulting has become a big part of their business. You can go in the world of corporate finance, do financial planning and analysis, work in treasury, be a controller, VP of finance, CFO. Many times those people have a strong accounting background working in the company, okay, or working for a big four and they come over. They can certainly work in government, in a nonprofit, academia. And then there's some specialty areas in accounting where we talked about financial, managerial, and taxes. The other ones, so growing field, financial forensics, looking for white collar crime, valuing how much a business is worth. Many accountants are getting into personal financial planning, and many have a strong understanding of systems, so they're doing IT consulting. Okay. And finally, at Villanova, what does the accounting major consist of? You'll take a total of 6 courses. Here are the 4 required ones: intermediate 1 and 2, the tax course and an audit course, plus 2 accounting electives. Okay. If you want a minor, it's 3 courses, intermediate 1 and 2 required, and here's a laundry list, of all these other courses that you need 1 more of. So here's, the elective, so to speak, for the minor, right? So there is accounting. Okay. So that is it. And hopefully I'll be able to end this now.